much for joining us. My name is Cynthia Duncan, and I'm a senior financial advisor at Summitry. And today we have select financial advisors from our private client group who are going to talk to us about the concept of tax planning and how we can use it to achieve our financial goals. Our objective for today is for you to learn something about tax planning, and hopefully through the conversation you can identify specific areas that you might want to explore in greater detail with your financial advisor at Summitry. So let me go ahead and introduce our speakers for today. So first we have Erin Zager, CFP, Advisor Group Manager, Claire Schifrin, CFP, Senior Financial Advisor, and Adam Govani, CFP, Financial Advisor. Here's our agenda for today so you know what to expect. We're going to start by explaining the distinction between tax preparation and tax planning. We then are going to walk through some case studies so we can apply these concepts to real life situations. Probably of a lot of interest, we're going to talk about recent tax law changes and what's being proposed under the Biden tax plan. And then finally, during the second half of our time together today, we're going to open it up for your questions around the topic of taxes and tax planning. You can go ahead and enter a question at any time during the presentation using the Q&A icon at the bottom of your screen. And with that, I'd like to go ahead and hand it over to my colleague, Adam, who's going to begin today's presentation. Adam?
Thank you, Cynthia, and thank you everyone for joining us this afternoon. So as Cynthia said, one of the questions that we often get is, I've got someone who prepares my tax return. What is tax preparation? And when you talk about tax planning, what does that actually mean tangibly? So we thought it would be helpful to kind of define that difference. And when we think of tax preparation, it's generally going to be, or tax planning, so tax preparation, we're generally reacting to situations that change. It's transactional. You're usually signing over that your tax return has been prepared, you're paying the IRS, or you're getting a refund. Oftentimes, this can lead to large surprise bills. There's often, like you said, you're going into your tax preparer's office and you get kind of a black box of, okay, now you owe X amount of dollars. And one of the problems is we're really not able with tax preparation, although obviously an essential thing that needs to be done, to plan for how we can reduce the next year's taxes. At that point, we're out of that current tax year. Let's say if we're trying to make changes in February or March. And again, we're forced to be kind of reactive to things that change. When we talk about tax planning, it's about planning for what we project is going to happen in the future. Whether it's things like sunset provisions that are going to be changes that are phased out over a period of time. Let's say we need to come up with a multi-year scenario around retirement, Roth conversions, or just a change in jobs, any sort of life circumstance. We know that a lot of things play out over several years. It's not just a snapshot in time. It's about coordination with your tax preparer so that we know things like quarterly estimated payments are going out, that we've got our strategy that's in sync with what your tax preparer is thinking. One of the things we're doing today, and we're often talking about with clients, is how can we proactively manage changes? There are a lot of changes that happen, some of them probably 15 minutes before this webinar started, so we want to make sure we're thinking about the future. And more importantly, it's not a one-time-a-year transaction. It's holistic. It's understanding how that tax plan fits into your financial plan and the rest of your life. So we want to make sure that we're capturing everything, and it's really about looking to the future, not thinking about the past. And I think there's really no better way to illustrate that with some case studies. So I think Erin is going to be starting off today with our first case study. So Erin, I'll turn it over to you.
Yeah, thank you, Adam. Welcome, everyone, and thanks for joining us today. We are in the heart of tax season, so we thought it would be really timely to review a few case studies and discuss the proposed Biden tax plan. I know there's a lot of questions surrounding that, and as Adam said, new things are coming out basically every minute. Also looking forward to the Q&A session. We had some really good questions by the audience today. So looking forward to that. It's very timely, and we have a great panel with us today to answer your questions. And just to add on to Adam's point, most CPAs have a very short window to collect your prior year tax documents, enter data into their tax preparation software, and file with the IRS and the state. They're very much backwards looking, and there's very little you can do in the form of tax savings on April 15th, or in this case, potentially May 17th if the IRS extends the tax filing deadline. We take proactive strategies throughout the year, such as taking advantage of things such as pre-tax employer benefits, the best ways to deduct charitable contributions, considering Roth conversions, strategies for our clients who are going through liquidity events, and so on. So at Summitry, we have very sophisticated tax planning software, which allows us to simply upload your 1040 and generate a tax report. We can look for tax planning opportunities, and we can even run multi-year tax planning scenarios to optimize your taxes. So we'll go through a few case studies today. With that said, I would like to introduce you to Raj and Maria. Raj works at Google, Maria works at Apple, both in the top earning years of their life. And they both receive equity compensation in the form of restricted stock units, or RSUs, as they're called. If you're not familiar with RSUs, it's stock that's granted to an employee. There's usually a vesting schedule whereby you don't receive the actual shares until a future point in time, as long as you're still employed with the company. Here in the Bay Area, it's an expected benefit from most employees at publicly traded companies in the Bay Area. So Maria has quarterly vesting of Apple RSUs. Raj has monthly vesting of GSUs, which, if you don't know this, Google likes to Googleize everything. So their restricted stock units are called Google stock units. So they same exact thing, only with a Google at the beginning. So they file married, filing joints, and if you've received RSUs, you know that the price of the stock at the time of vesting is considered ordinary income. It simply runs through your W-2, and shares are immediately liquidated to pay for taxes. The big problem that many of our clients face is that most companies by default only sell 22% to pay to the IRS and only 9.3% to the state if you live in California. So in the case of Raj and Maria, they're in the highest marginal tax bracket, which as of right now is 37% federal and 13.3% state. So every year, not only do they have this huge surprise tax bill, they almost always owe penalties and interest. Now, it's one thing to pay the taxes that you owe, and we can help you with minimizing taxes. It's something entirely different to pay unnecessary penalties and interest. That's where the planning comes in. We were able to look forward at Raj and Maria's current tax year, and we actually coordinated with their CPA. We projected taxes owed with some degree of certainty. And when I say some degree of certainty, RSUs, it's income as they vest. So obviously there's certain assumptions regarding the price of that stock at the time of vesting. We were also able to let them know what the safe harbor amount was. And if you don't know what safe harbor is, it's the amount of taxes that you can pay to avoid penalties and interest altogether at the federal level, not necessarily at the state level. For them, it was either pay 110% of the taxes owed last year or 90% of what they owed in the current year. So even though they might have a tax bill come April or May 17th this year, they at least avoid penalties and interest, which is something that everyone should make an exerted effort to do. So we're able to save them thousands of dollars in taxes and avoid a surprise 2020 tax bill. That is the story of Raj and Maria.
I will take it from here, Erin.
Thank you.
I just wanted to share a unique story about how taxes have played into an ongoing and multi-year conversation about retirement planning. So for this, we'll just introduce you to Jane and Roger. They are active retirees now, but when we were having this conversation back in 2016, the picture was a little bit different. Through all of these past several years, there have been so many updates to the tax laws that we've had opportunities to take advantage of them as they've come up on the books. Jane and Roger originally met long ago on the slopes, and they actually had an aspiration to spend at least part of their active retirement years back near the slopes in ski country. But they've, of course, with their professional obligations and lives, been very much saddled with staying in the Bay Area, and their travels mostly been for work. Roger had been with a big tech company, and Jane is actually self-employed, a sole proprietor who consults to other small businesses. And so as such, they've always been high income earners, and most of their savings has really been in tax deferred accounts like 401ks. They had shared some of the aspirations about living closer to the slopes or spending more time skiing while they still could. And in 2016, Roger was unexpectedly downsized from his company. So this really prompted the rethink. Could they retire now? Could they move? And all of those decisions really come with tax impacts. And so really at that point in time, we sat down for a conversation, and we use our financial planning software to model some of the impacts of those decisions before they're ever made. So in this case, they were deciding, what does it look like using our 401k dollars to fund our retirement? What is the tax liability for doing that? Should we sell our home and take advantage of capital gains exclusion? Those rules really haven't changed much. Should they consider a 1031, which is a tax deferred exchange for real property, since they had to, and we're trying to figure out how to employ their home equity in their retirement picture. And with the option to move away from the Bay Area, that's really what they decided, to live in their vacation home, rent out their primary, and spend a couple of years enjoying the slopes. Then the following year, in 2017, with the Tax Cuts and Jobs Act, there was a new pass-through law where, as a sole proprietor, Jane was still working, and she was able to suddenly pass through about 20% of her income free of tax. And so couple that with not having a second income, their marginal tax rate went down substantially. And that opened the door then for a conversation about whether Roth conversions for Roger made sense, since he was closer to having to start his required minimum distributions, and the taxability of monies, if it isn't between husband and wife, but to their children, suddenly the stretch provision, which children have benefited from in the past, suddenly went away. The new law is that you must take the IRA distribution, if not annually over 10 years, at least in full by the 10th year. So that can create income tax liabilities for a next generation who may be inheriting IRA monies. Pushing ahead to 2019 with the Secure Act, they got a couple more years to defer taking Roger's required minimum distribution. So that's more years potentially for him to convert and hopefully reduce that required minimum distribution from his IRA and lessen their taxable income in retirement. They may decide ultimately to move back to the Bay Area when skiing's behind them. But again, with the laws continuously coming out, it's really been great to stay in a planning conversation with them and think through how they can take advantage of the new laws on the books. And with that, I'm going to turn it over to Adam.
Thanks, Claire. Our last case study for today, wanted to introduce you to Meg and William. Meg has already retired. She retired a few years ago. And William had been planning to retire in 2 to 3 years, but pre-COVID, that was the plan. After having worked and been in shelter in place for a while, working from home, he was starting to think about, is it possible if I retire, maybe now, maybe in a few years, but more importantly, am I leaving something on the table? And have I thought about the actions I need to take now in order to be successful in the future? So the first thing we did, obviously, was the financial planning, which is really the crux of where we want to start, and understand that it would be feasible for William to retire this year if he so wanted. Then from a tax perspective, we had to think about what is the most effective way to leverage what is available in a tax efficient manner. So for William, he had accumulated company stock over the years. Retiring from NVIDIA had done well for him, but given the proximity to retirement, it had definitely been on Megan Williams' mind for a while to diversify. And then on top of that, William also had stock options that he knew he was going to need to exercise in the year that he was leaving, whenever he decided to leave. And so we're able to realize, okay, we know whatever year William decides to take this action, he's going to have a big tax liability. And so we want to make sure that we've planned out our taxes, not just for this year, but we're thinking about what actions can we take proactively, whether William decides to retire this year or not. And how do those sort of decisions around options relate to the kind of ongoing diversification, maybe moving into a more conservative portfolio, but positioning them for a place where they feel comfortable and secure during retirement? And so what we're able to do is plan for William and Meg to make a large contribution to charity, something they had thought about doing for a while, but oftentimes you're saving for retirement and it's one of those things that is easy to put on the back burner. They knew that they wanted to give charitably, but let's be honest, we want to make sure that we're optimizing the tax benefits within that charitable framework. The thing that made the most sense of them, or the most sense for them, was to front load a contribution to a donor advised fund. A donor advised fund is essentially a charitable vehicle that allows generally a contribution in one year to be distributed over multiple years. So if I have a lot of income one year, I might not necessarily want to distribute my whole charitable contribution in that same year. And so it allows us to take advantage of when do we need the deduction versus when do we want to provide that support for charity. For them, it made the most sense to consider a donor advised fund, not because that's the only solution. We can certainly discuss other ones, but they wanted something that was a little bit more easy and flexible to use, to which William was able to donate some of his appreciated NVIDIA stock, both capturing the tax deduction and also allowing them to reduce the total amount of exposure they had to one company's stock. We were then able to come up with a long-term diversification plan where we're looking out, okay, past Williams' one big income year, how are we going to fit income into other years, generating those capital gains, diversifying over time, thinking about things like Social Security, required minimum distributions. But unless we're looking out 2-3 years, it's really hard for us to understand what we should be doing now and how it's going to affect us in the future. And what that really provides is the peace of mind, understanding intellectually, yes, my financial plan says I can retire, but also I have a plan for the next 2 to 3 years, what I need to do over what period of time. And that gives you the confidence, I think, when you can see tangibly the numbers. It was easier for Megan William to come to that decision that William's able to retire on his own terms. If he has the chance to get back into the office and he absolutely loves it, maybe he stays there those 2 to 3 years. But both of them have the confidence that we've come up with a tax efficient strategy. Should this be the last period of time and they decide it's time to transition to spending more time together. And then hopefully, I'm sure all of us are looking forward to traveling again in the near future, which is certainly one of their goals. And I think the next topic that we wanted to discuss, first off, we think case studies are an excellent way to illustrate how some of these tax planning concepts go from the high level strategy to more down into the tactics and how we help assist. But at a very high level, one of the things we know about tax law is that it's constantly changing. I believe Aaron mentioned this earlier, but as Aaron, Claire, and I were kind of checking our notes and preparing for the meeting, we got at least reports that the IRS may be delaying the tax filing deadline. We don't have confirmation from the IRS, at least yet. But I think it really illustrates the point that, and Claire said this, really hit the nail on the head. There's always, the ink has yet to dry, and we get a new tidbit of tax information that's going to change perhaps how we plan, or at least how we're thinking about some of this administrative work. A lot of that possibly chalked up to some changes that came in the American Rescue Plan that just passed, particularly around unemployment benefits. The IRS is also sending out stimulus payments. A lot is happening on their end. On top of that, Claire mentioned the Secure Act. We've also had the CARES Act, the Tax Cut and Jobs Act, the things that have changed in the last 5 years. It's a completely different set of tax laws. I know one thing that was a huge pain for all of us in California and any other high tax state was losing that the cap on $10,000 for state and local income taxes. And one thing that we're sure of is those changes will continue into the future, whether it's this administration or going on. It's very clear that tax law is A, complicated, and B, consistently in flux. And to that end, we do get a lot of questions, especially with the change in administration and some different priorities in terms of tax policy. What things are coming in the pipeline, and what actions do I need to take now? And before we start discussing any proposed tax law changes, not that any of you expect this of us, but a caveat, we're not legislative analysts. We're not going to be handicapping which one of these will pass and what a probability is. But we do get so many questions, and we completely understand that it's top of mind. It's all across the headlines. And so we wanted to make sure that we introduced you to some of these concepts, and then also introduce some of the planning concepts that we're thinking about as a team, and that we'd be prepared to refine and implement with our clients when and if some of these changes occur. Which any change to legislation, you've got to say when and if to understand kind of what we might need to do from a planning perspective.
And the complexity of it, I'll just add, Adam, the complexity of it, this was given a little bit more time than the CARES Act that was kind of rushed together. And we saw provisions almost every week because lawyers and CPAs drafted it up, but it wasn't necessarily practical. With this, we are following this closely with resources that have information much more than we do. And yeah, this is just an evolving topic, really. I went on, I think Bloomberg and Wall Street Journal, and both are saying that it's probably nothing's going to be passed until next tax year. It's not guaranteed by any stretch of the imagination because the tax law is volatile and ever changing. But we'll keep everyone on the call in the loop in our blog posts and things like that, and with your financial advisor.
And it's, Aaron, it's not unlike something has changed since this webinar began. So we're reading before and we'll be reading afterwards. Right. But each of us wanted to take the time to discuss one of the proposed changes. And when we say proposed changes, things that have been, again, widely reported on, have been spoken on by members of the administration, and we think are also going to be the most salient to our clients. And the first change is really at that $1 million income threshold. And it's going to affect the taxation on capital gains and dividends. Now, let's think about thinking about how that change would affect you in your financial plan. Right now, you've already hit, if you're coming up on $1 million in income, even for married filing jointly couples, you've already gone way past really the point at which you're going to hit the highest federal tax bracket. So going over $1 million in income, the difference between $999,000 and $1,001,000 was really that extra 1%, the quote unquote millionaire's tax for those of you residing in the state of California, which is most of our clients, but an important caveat. And often that was it certainly depends on the amount of income that's generated in that year, but 1% is not a huge delta. And so often there may not be as large of a benefit to waiting. That being said, now that we've got, or if we were to receive kind of a hard and fast threshold above 1 million, and for context, what has been discussed is raising the taxation on capital gains and dividends to the highest federal tax bracket, And Claire will discuss this a little bit later, but a proposed shift from 37 to 39.6. So the highest bracket, but also an increased highest bracket. And so when we talk about multi-year planning, this provides a lot of opportunities for us to say, how can we shift income from one year to another, especially for those of you in your high earning years, or those who are selling significant assets, whether it's an appreciated stock, a home, whether that's things like an installment sale or just being smart about how we do charitable contributions. There's a lot of strategies we can employ because frankly, this would be a relatively large departure from how those sorts of calculations are made at this time. And so we'd want to make sure that if the income is going to be up at that level, that we've thought about, are there ways to shift things across multiple years, take losses? Because for the vast majority of people, generally long-term capital gains are taxed at 20%, depending on your income tax bracket. Can be as low as 0, but for the vast majority of people is 20%. With an additional 3.8% Medicare tax that can be added on, anything above $250,000. So the delta there is pretty substantial between 23.8 and 39.6. So that certainly factors into our calculations. And if something like this were to pass, it's going to be on a case-by-case basis, but know that we've got opportunities, we've got the ability, especially looking out over multiple years, to be able to see how this would affect your financial plan and whether or not we need to take action. To Aaron's point, we don't know exactly when changes, again, the when and if component of it, but to reinforce what Aaron said, know that we're watching these things. And as we find out more information, we will be planning to see how we can best accommodate that within your financial plan. And Claire, I think I've alluded to potentially higher tax bracket, so I'll transition to you. I know everybody likes the term higher tax bracket. So tell our listeners a little more about it.
Well, you were throwing out a lot of numbers in that. So if the salient point that I want people to remember is really that the highest marginal tax bracket under the Biden proposal would go back from 37 to 39.6% for those who are earning over $400,000. And then a secondary note is for those who are earning over $400,000, the Social Security tax will also go up to 12.4%. So that is, in simplest terms, I think, what the clear impact would be. And again, being in a high income tax state, we would want to think for those who are in California, for example, where this puts them in their marginal tax rates as well. And with that, I will turn it back over.
All right. Thank you, Claire. So on the business front, this is a pretty big change. And if anyone can remember pre-2018, and gosh, it sounds like it feels like forever, corporate tax rates were 35%. So from the Tax Cuts and Jobs Act that was enacted by the Trump administration in 2018, it went all the way from 35% to 21%. The proposal in Biden's plan is to raise that corporate tax rate from 21% to where it is now to 28%. So it's not necessarily going back to pre-2018 numbers. It's kind of a let's meet you in the middle type proposal. So corporate tax rates from 21 to 28%, which is a pretty big jump, especially if you're looking at large multi-billion-dollar companies. It won't really affect small business owners and consultants and S corps because all of that just runs through your 1040. So you'll still fill out a Schedule C. All the income will just go to you directly, and you'll file it as income on your regular 1040. So this is more about corporations.
Aaron, if I could just add one thing, for our clients who have C corporations, that is the circumstance in which it would apply. But as Aaron said, sort of pass-through entity, S corporation, this is less what we're talking about, more on the C corp. So for some of our clients, but also again on the multinational or large publicly traded company side is where you'll see the larger effect, at least on a dollar amount basis.
Right. Thank you, Adam.
Great. Thank everyone for your comments today. Much appreciated. So we're now going to transition into the question and answer segment of the presentation today. So just as a reminder, if you'd like to ask a question, please use the Q&A icon at the bottom of your screen, and we'll get to as many questions live today as we can. And so just to start, I'm going to ask the panel just to speculate a little bit. So we think that the federal tax filing deadline may be extended a month. What's the likelihood that California would follow suit? And maybe a follow-up question is, what's the best place for clients to confirm the deadlines?
I'm happy to take that one. And please, Aaron and Claire, please feel free to add in. I won't assign a probability to it. I will say in general, the states take their guidance from the IRS. And so if the federal deadline were to be pushed back to, let's say, May, it is not unlikely that the state of California would do so as well. Claire and Aaron, please feel free to step in if there is some restriction. But my general understanding is the states follow the IRS, not necessarily required to. But it would create, I think, a large headache for everyone if they needed to file their federal taxes in May and then file their state taxes in April.
Yeah, I would only just add that we would like to go directly to the source, either to the IRS directly or to the Franchise Tax Board in the case of California, so that you know what the actual entity is saying and what deadlines they're proposing.
And just to look at history, you know, the 2018 Tax Cuts and Jobs Act was a pretty big differentiator from the previous plan. So the federal government, the IRS, changed a lot of their different IRS rules and regulations and provisions, and California really didn't change many. So as Adam said, it's really up to the state to decide, and there's just so much uncertainty at this point what California is going to do. And this is still a proposal that will probably go through numerous provisions and revisions before it's actually rolled out. I mean, it still needs to get the stamp of approval from Congress. So this probably isn't going to be something that's rolled out, you know, in the next month.
Great. So Aaron, I'm going to direct this question to you. So many clients on the call use accountants, and some prepare their own taxes using TurboTax or other online tools. Can you talk about maybe when someone should hire a tax advisor, and when it's perfectly fine to do it by yourself?
Yeah, good question. And you know, I've prepared taxes for probably half of my career. There's a lot of considerations. Many of our clients are just really busy professionals. So one consideration is just time. I mean, do you want to pore over all of your tax documents, enter into the H&R Block or TurboTax software, and then hope you get everything right? And if you have significant income, even though your tax situation might be simple, I would want a second set of eyes looking at that before I submitted it to the IRS in the state. There's also a lot of benefits, even if your situation is relatively simple. One consideration is just the benefit of working with the same preparer year after year. They know your situation, at least your tax situation, and they're able to compare current year versus prior years to make sure that you haven't forgotten anything. And most of your financial life is reported to the IRS electronically. So if your bank issues you a 1099, the same data is reported to the IRS. So if you forget to report it, you'll receive a not so nice letter in the mail from the IRS in the States, and it's going to be up to you to pay interest, penalties, and or amend your tax return. I would also say that I mean, more complicated cases, absolutely. There's a necessity for a tax preparer. If you own investment real estate and you're trying to prepare your own returns, there are just so many deductions that are available to you as an investment property manager, and that's owning it directly. If you own something like a real estate investment trust or limited partnership, you'll just receive a K-1. But if you actually own a property outright and you're filing it on what's called Schedule E on your 1040, a tax preparer will help you receive all the deductions that you're allowed. If you have a sale of a property, especially if you're a business owner, if you're a sole proprietor or just a business owner in general, and you're just filing a Schedule C, again, kind of like investment real estate, probably more so as a business owner, you can receive so many deductions. Qualified business income, there's all of these deductions and depreciation rates. It gets really, really complex. And probably the amount of money that you would save hiring a tax preparer would probably exceed the amount that you're paying in taxes. Also, if you own alternative investments, the last thing I can think of, and there's a lot more, but our high-tech people in the Bay Area, a lot of them have the benefit of employee stock purchase plans. And when you sell ESPP, most of the custodians report it wrong in their tax reporting. So you actually have to amend the cost basis. And with a lot of people, they actually pay tax twice when they pay ESPP shares, unless they correct the cost basis on their tax return. Good question.
Yeah. And I did notice a question in the chat that I think might be perhaps a good example of this. Notice someone had asked about where on TurboTax to put in information for a CRUT. For those not familiar, that's a charitable remainder unit trust. I would love to hear more from you, and I'm sure your advisor would as well. Can't speak directly to TurboTax, the software, but to Aaron's point, that might be a situation in which it would make a lot of sense to at least talk with a tax professional. It's a complex trust, both in the figurative and the literal sense. And there's all sorts of, filing a trust tax return as well. Certainly don't want to imply that, not perfectly capable of doing so. But I think to Aaron's point, that's the situation where the complexity might warrant, at a minimum, a conversation with a tax professional to make sure that A, things are done correctly, and B, mostly that there might be something that, perhaps that you're missing that a tax preparer, especially one who has experience with charitable trusts, may be able to identify for you. But I certainly recommend you chat with your advisor. I know that they'd be happy to help you. And Cynthia, I'll turn it back over to you for some more questions.
That's great. Thank you, Adam. And I guess the only thing I would add is it doesn't have to be either or. And I think that's what you're getting at in your answer, is that if you have a year that's particularly complex, you can certainly use an accountant. And in years when your tax situation is perhaps simpler, TurboTax is a perfectly fine tool. So I want to shift gears. We have a number of questions about Roth IRAs. And I think it's fair to say generally we're a fan of Roth IRAs where it makes sense. And so I think maybe just to set some context, maybe you could talk a little bit about what a Roth IRA is and why it can be so advantageous to investors.
Yeah, I can take that. Yeah, a Roth. First of all, when we're planning for your financial life, it's always a good plan to have multiple buckets that are taxed in different ways. Your individual or your trust account, that's taxed as you go. A traditional or rollover or 401k, pre-tax 401k, that's taxed as you take distributions. A Roth IRA, when you contribute to it, it grows tax-free, which is, especially if you have a longer time horizon, Roth IRAs are a great investment vehicle. The problem is that there's income limitations to contribute to a Roth IRA. So if you're married filing joint, your adjusted gross income has to be lower than 198,000. I think for single, it's around 125, if I'm not mistaken. One alternative, and many of the high-tech firms in the Bay Area have adopted this over the last couple of years. They've allowed employees to not only max their pre-tax 401k, so every dollar you put in the pre-tax 401k, that's just a reduction of taxable income dollar for dollar. But many of the high-tech firms, many firms in the Bay Area, I don't want to just say high-tech, as many others do this as well, they allow you to contribute to a pre-tax 401k and then do an in-service withdrawal to their Roth 401k. So it's a backdoor way of contributing to a tax-free account. And if you have the cash flow, this is a great strategy to grow tax-free assets in addition to maxing out your pre-tax 401k. And some companies allow automatic movements from your after-tax to Roth, some don't. So it all depends on the company. This is relatively new concept, but many of the larger firms are adopting it.
Yeah, I also just wanted to say that even if you aren't able to do this in your working years or you are in retirement, then the Roth conversion is also part of the plan because you still have many, many years to live in retirement. And so the opportunity to turn those tax deferred dollars into tax free dollars in your lifetime or even for your beneficiaries can be a good planning strategy.
And Claire, just to expound upon that point, even if you are in retirement, we do get the question, and just got this question the other day from one of my clients who I believe is on the call today. So look forward to chatting about it afterwards. But really the requirement is having some level of earned income. So let's say you're retired, but maybe you still run a small business on the side. Maybe it's consulting, or you're kind of phasing out of something that you were doing previously. As long as you have enough to be able to contribute to a Roth IRA, so presumably you're over the age of 50 at that point, you'd be contributing $7,000. Pre-50, it would be $6,000. You would need at least that amount of earned income, which even if you're working a side business, it probably is a reasonable amount to think about. And then on top of that, you can make what's called a spousal contribution. So if you are working and your spouse is not, you can make a contribution on their behalf, with the caveat that you need to have at least enough earned income to be able to make a contribution on both people's behalf. And I just want to address just kind of the last point. We get the question a lot, traditional IRA versus Roth IRA. A lot of people really love the tax-free growth of Roth IRAs. This is when the multi-year planning, and this is really where, especially financial planning, so not just looking out 2 to 3 years or 5 years, but 20 years, it's really the circumstances. What is your tax bracket now? And from what will your tax bracket be when you're withdrawing? And that's a combination of tax planning and financial planning are how we help answer that question, whether it's contributions, employer plan contributions, conversions. It's all a matter of how that plays in with what your tax bracket is now and what it will be in the future.
Great, thank you. And Claire, I'm going to direct this question to you. So we did get a question around, are there any tools or software to help determine kind of the optimal timing of Roth conversions? And you might be able to expand that in terms of just tax planning software in general.
Yeah, I think it's a great question. And it does give us a chance to showcase some of the resources that we'd like to bring to our clients. Namely, we've adopted a new tool called Holistiplan, which allows us to look through your tax returns and try to strategize for the current year with doing things such as Roth conversions for a given year, how much to convert and where that might put you from an income tax standpoint. And so in order to do that, we actually We have our website where you can securely transmit your tax return. We'd love to make sure our clients know their financial planning associates who can help them get the documentation in, or W-2s if you're still working, to us securely, so that we can do that kind of analysis for you. To the point about timing, I mean, we can look at it from in the current year, does it make sense to do this broadly? But if it's, there is another opportunity like last year where the market declined substantially, I would think about that as the optimal time to do a Roth conversion, because when your IRA value is low, you can pay less tax on the amount you convert. And if the market takes off like it did last year, you're already a gainer in that circumstance. But that's as far as timing the market as we would go with that. But I do think that the Holistic Plan adds a huge amount of depth and detail for the Roth conversion conversation, as well as many of the other strategies we speak about with clients.
Great. So I'd like to just spend a few minutes confirming some information around the tax law changes that we talked about earlier that are being proposed under a Biden plan. So the first question is, we talked a little bit about potential changes for earners who make over $400,000, or households who make over $400,000 a year. Are there any changes being discussed for income below that limit?
Go ahead, Aaron.
All right, thank you. Biden has been pretty adamant about anyone earning less than $400K a year, their tax situation won't change. That doesn't mean that it won't, but that's what he's kind of told the general public. Again, as Claire says, as soon as the ink is dry, that's kind of when proposals get passed, and it needs to get passed by several different layers. So that's not a great answer, but that's the answer.
Is as much as you know at this point. So another question, and this is a little bit of a nuance. And so we talked about the increase in capital gains taxes for people who earn over $1 million. Do any of you have a sense if that is earned income through employment, or if it's total income, employment plus investments?
My understanding, and again, we're shooting a little bit in the dark here, but it would be based on adjusted gross income. And that's how it would be calculated. So as part of your adjusted gross income, capital gains, earned income, there are a lot of things that factor into your AGI. So as far as we know at this point, all necessary disclaimers, it'd be based on your adjusted gross income. So, and I think the question probably speaks to, if I have $300,000 in earned income, but I sell a bunch of stock and I have $800,000 in capital gains, would that be something that's subject to that kind of $1 million threshold? And from what we understand so far, yes.
Okay, great. So there's a couple of questions around charitable contributions. So the first question is there a limit in terms of how much can be deducted as a percentage of income? So maybe I'll pause there and then I'll ask the follow-up questions.
Yes. No, I'm just kidding. Aaron or Claire, do either of you want to take this? All right. Well, so
Claire's on mute, so go ahead, Adam.
I was going to say, so to answer your question, yes, it's generally based on a percentage of your adjusted gross income. So there are a wide band of options. So a good example, one that's frequently used, is long-term capital gains property. So often, let's say an appreciated stock, that is going to be subject to a limit of 30% of your adjusted gross income. Whereas something like a cash contribution, and there's a one-time exception, this was a little different in 2020, but on a go-forward basis, it limited to 60% of your adjusted gross income. There is a higher degree of nuance There are some organizations where it's limited to 20%. Certainly encourage you to speak with your advisor, and they can help you suss out the difference between, depending on what type of property you're donating, that is going to really affect that amount. I do think it's important to note that you will get a charitable carry forward if you exceed that amount. So it's not like that benefit is lost forever. I would think of it as there's a limitation to what can be deducted in 1 year. And just to add one layer of nuance, because I know someone did bring up a charitable trust. For a charitable trust, again, recommend talking to a tax advisor, but there's actually a calculation that goes into what your charitable deduction is going to be for something like a charitable trust. And so there's a little higher degree of nuance there, but it really depends on what you're donating, and it's based on a limit of your adjusted gross income.
I also wanted just to append something. It's kind of a tangent, but sometimes there are credits, tax credits that are available, but you need to have income in order to be able to recognize the tax credit. So there can be a way or opportunities sometimes to actually recognize income in a year in order to be eligible for a credit. So sometimes the deductions matter to people and sometimes the credits matter. And we want to be in conversation so we can help you figure out what that is and the best way to achieve the benefit that gives you the most advantage with respect to the tax code.
Great. And then sticking with you for a moment, Claire, the CARES Act was passed about a year ago and had a number of stipulations. And I think there's one related to charitable giving that has been extended into 2021. Maybe you could talk a little bit about that.
That is specifically for cash contributions. I think it was $300 for individuals and $600 cash contributions for joint filers. And that is continuing into this calendar year.
Great, thank you.
Cash. In most cases, a lot of times when we're trying to advise on making donations, we're looking at highly appreciated stock positions or property, long-term capital gains, but there is a benefit in this case for a cash donation.
Great. Now we have received a number of questions about the cap on the deduction for state and local taxes. And, even we know a lot of people consider moving out of California because of the high tax rate here, both on income and property taxes. And so, again, asking you to speculate a little bit, is there a chance that that might be adjusted under a Biden tax plan?
How did it take so long to get to this question, Cynthia?
Well, I wanted to go easy on you first.
Yes, I think all of us, at least California or other high tax residents, probably missed the SALT deduction. Owning a home in the area, your property tax very well exceeds $10,000. So it's really a caught benefit there. This is a tough one. Just kind of thinking about and Aaron had kind of alluded to this, Claire had as well. The goal of the tax plan, it seems like, is the tax hikes are really focused on those making above $400,000 and those making above $1 million. So thinking about, will we get the SALT deduction back? Generally, the value of that is going to be most valuable, obviously, to people in high state tax or, states with a high level of state income tax. But also those, and just kind of playing out the research, with those of an AGI on the like $100,000 to $500,000 range. Obviously, if your income is very high, the absolute benefit is going to be a lot larger. And the point I'm trying to draw from this is just looking at the numbers for the state and local tax, because the numbers generally tend to accrue to the higher income earners. It may be less popular from a, if you will, just the optics. And again, this is where it falls into speculation. There's also a little bit of a partisan divide. If you look at the states where the AGI, or as a percentage of AGI, the benefit is the greatest from removing that SALT cap, generally tends to be the quote unquote blue states. Those where there's the least benefit tend to be quote unquote the red states. So there's perhaps a level of partisanship that might go into it. That being said, it is a relatively high priority. A lot of people in California, New York, have objected And for some, it may actually be influencing some decisions. And so although it is a high priority for those in high tax states, it's not quite clear how it fits within the framework of that plan. I know we're hedging our answers here. We certainly can't tell. What I would say is, given how the benefits are distributed, it might be a little bit difficult. That being said, a lot of representatives from high tax states, that's very high on their list of things they'd like to get back into allowing people to deduct at the federal level their full state and local income tax.
Great, thank you. So before we conclude today, I think we have time for maybe one more question. I do want to let everyone know that we do have a blog post on our website about tax planning, and I think it would be a really nice complement to today's webinar. So I encourage you to check that out at www.summitry.com, and that can be found under Insights and Resources. And the other comment I want to make is, as you can see, tax planning is highly individualized, and so all of us really encourage you to reach out to your advisor for specific conversation around your own circumstances. And I will say we will follow up with questions that we didn't get to today, but if you did ask your question anonymously, I do encourage you to reach out to your advisor to get those questions answered for your situation. So I think our final question today, Claire, I'll direct it to you, and anyone else can chime in. So the gifting limit has remained the same for 2021. So it's my understanding it's $15,000 per year per individual. And we have a lot of parents in the Bay Area who want to help their children with down payments. And so how can the gift rules be used? You know, 15,000 isn't a lot. So what can parents do to potentially expand on that, or what options do they have?
Sure. So timing can be a benefit. So if you are trying to maximize that $15,000 amount, husband, wife, 2 children, you can try and make distributions in December and January to try and keep gifts at the exclusion amount, but spread it over a couple of tax years. That's a simple way to do it. But if you are really trying to give substantially more, this is really where it might actually delve into the estate planning type techniques, which could include intrafamily loans. There is something called the applicable federal rate. So if instead of having to go to a bank to help your children buy a property, you can be the bank of mom and dad and arrange a note to give your children the money that they need to make that down payment on a home, and then they can agree to pay you back over time. And so when you are structuring something like that, you will really want to work with an estate planning attorney. And we have a bevy of resources in that area, just so that it's all a kind of coordinated with your overall estate plan and wishes. And again, if you're filing any or making gifts over that exclusion amount, you will also want to file a gift tax return, which is also called a Form 709. Just to record that you've made a gift against your lifetime exclusion. But those numbers are extremely high. But again, this is where sort of you're bridging both the income tax laws and the gifting tax laws, estate tax laws.
And just adding, I know we're running up on time here. The 15,000, if you're married, you can gift 30,000 to any individual, and that will reduce your estate amount. So if you're a married couple with 2 kids, you can contribute 30,000 each to each child every year. There's also ways to front load 529 plans, plans to fund educational expenses. So if they're looking for if they're young and they have time to let the money grow, 529s may be the right solution. And you can front load those, and all the earnings from now until they use the fund for higher education are tax-free.
Wonderful.
And private school now with the new rules.
Perfect. Well, I want to thank our audience for their participation today. We had a lot of really good questions, and I wish we had more time, but we'll be following up on the questions we didn't get to today. So I want to thank everyone for joining us today. We all wish you the very best. Thank you.